Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, May 11, 2022. It is 12:04 p.m. Eastern Time, so we're about halfway through the trading day, and I wanted to do an update. I'm going to cover the equity markets. I'm going to stay hyper-focused on those, but it's been a little while since I updated gold. I keep trying to get to it, but then the videos run long, and I kind of shelf it to the end, so we're going to do it in reverse order. We'll get to the equity markets last. I'll cover quick updates on gold and natural gas, and then get to the equity markets. I already gave you an update on bonds this morning, so nothing else to add there. Gold. Okay, this is a long-term, big picture. In the last update where I covered the weekly chart at least, I've been usually going to the 60 minutes for near-term analysis, and then the bigger pictures, the weekly charts. Forever and a day, I've been highlighting some levels here. First of all, this divergent high, big high, and that was also the matched the end of the last bull market all the way back from 2011. So when that hit, I talked about closing out all my gold and silver and mining stock positions trend trades, expecting a sizable correction, and that's what we got. And I still view it as a bull market correction. Remember, gold bottom, the bear market ended in December 2015 here. We went up and developed a key level at about 130.05. We were making higher lows but equal highs, then we broke out, and back then I said that was a major breakout for me, and that was the catalyst for the strongest leg up in the bull. And then, like everything else, even that previous bull market, you have consolidations. And so what I noticed after a while is we were setting up in a nice symmetrical triangle pattern right here, and said that favored a break to the upside, although break to the downside would have been bearish. Favor to break the upside, we got it, we ran up and then checked again. That's 1, 2, now 3. Remember, 2011 to the left of the chart was that same level there, approximately. So now we have these, triple top all-time highs in gold, or at least multi-decade highs in gold, I believe all-time, and that needs to be taken out. So when we got there, we had negative divergence as well, and it was major resistance. So expected at least a little pullback. Got a little more than I thought, but I've said all along that I'd give it all the way down to a test of the triangle. As long as we come in and we back test the triangle, and now when I extend the triangle lines, here's the apex right here of the triangle. You also have a longer term uptrend line, potential trend line coming in here, that off the bottom right there, and you have 164.80. So really that is it. That's where as long as gold pulls back and stays above these levels here, again, it all comes in together. So let's just want a hard number about 164.80 on a weekly basis. This is a weekly chart. Anything much lower than that, you're going to take out the triangle, both the downtrend line and the uptrend line, again, because we're approaching the apex of that triangle, that potential uptrend line off these lows back here, and then a pretty good price support level. We had gold testing that level here, and then it made a breakout, and then a final run, blow off type top, and so that's those are levels. That's big picture stuff, trend trading, investing, and then micro analysis, or shorter term analysis, I should say. I won't call it micro. Micro is really 5-minute charts, but anything on the intraday charts, if you want to say it that way. Here, let me get to that. My old tried and true, trusty and true 60-minute chart here. Okay, so as I've said recently, I'm not crazy about the recent price action in gold, but it's again, it's more of a trend position trade for me, and it's also a way to diversify. It's been suck and win lately, but not. I'm not throwing the towel away yet. I'm maintaining my position, as I told you, in my longer-term bullish outlook. So we've had, let me just kind of recap what's gone on recently. We've had a series of divergences, and each one has played out for a rally, but then that rally gets sold into. So we're walking down. Okay, so I first pointed this one out here. We had at that point positive divergence, and again, it's not as if it didn't play out, but what's going on here, if you look at these micro levels, you draw a micro uptrend line. That uptrend line was broken. That set up the next leg down. Then you had another downtrend line there. But here's the common theme here. Here's what I want to tell you. The divergence continues to extend. It's the same divergence. In other words, we generate all these divergences, including what's in place right now at the recent lows, generates off this low right here, this recent low. So that was divergent low 1, rally number 1. Divergent low 2, rally number 2. Divergent low 3, And now, generally, but not always, I have to say not always, but usually the bigger the divergence, the bigger the rally. And it happened here. This rally was from a small divergent low, followed by an even a slightly larger rally because it was a little bit larger divergent low. Now we have an even larger divergent low, and we have another minor trend line to pop, to watch and pop, and that gives us another little falling wedge pattern. So by that logic or that expectation, again, it's not guaranteed, we should see a bigger rally at that point, and possibly because we're getting close to that support on the longer term daily chart, a bigger move. I want to show you one more thing on a related note. Let's look at the euro US dollar. The US dollar and gold tend to move, especially over longer period of times, inversely. It's simple, it's mathematics, it's not very complicated. Gold, at least the gold you and I are, or at least I'm trading. You might be over in Europe or somewhere else around the world trading in different base currency, but we trade gold futures here, or GLD, and most gold around the world is priced in US dollars. So therefore, when the dollar goes down in value and depreciates, it takes more dollars to buy an ounce of gold, and that's bullish. When the dollar goes up, as it has been rising, that's bearish because it takes more dollars to buy an ounce of gold. More dollars when the dollar drops. I'm sorry. So a falling dollar bullish for gold, rising dollar takes fewer is bearish. And here we can see the euro is basically an inverse chart of the dollar. And that is simply because the US dollar, when we say the dollar, I'm talking about the US dollar index. And you can Google it and you'll get the weightings. They haven't changed for years or decades. It's I think it's like 50. Don't hold me to it. It's like 57.6 or 8 percent euro. The yen is a distant second, like 20 something percent, maybe 23 or something like that. And then everything else, all the other currencies, including the British pound, all that, are minuscule. Again, because you have, over 2/3 of it alone. Well over 2/3, I think, is the dollar and the yen. I meant to say the euro and the yen. So here's the thing. We have the euro now at major long-term support. We can go back as far as we can roll here. This is in the 2008, so you're seeing a multi-decade chart of the euro. And this is 2015 here. The year gold bottom right there, and had a rally off the low. That was the end of the last bear market in gold in December of 2015. Euro triple tested that low there, several tests, came close there, and we're right back to that level now. So you have the euro at long-term support, oversold. And this is just persistent oversold readings. We had divergence there. No divergence now, but again, we are oversold. So that's just something to note that could, if we can reverse here and hold this support and rally, minimum target would be up to this downtrend line. That should be a net positive for gold if it happens. And if not, hey, if gold takes out the bottom of the triangle, and that 160.80 level, you have this uptrend line off the recent lows. That's going to be bearish, at least from a technical perspective. Doesn't guarantee that gold's going to fall, but it certainly isn't going to be a bullish event. That's a confluence of support right there. So again, down to about 164.80. Ideal if it kisses the trend line. We even have support here right where we're at it now, about 174 or a little hair below it. So just a whole confluence of support there. And we do need to note we had negative divergence at that recent high, and that divergence so far is playing out. Could play out for more. All right, there's your update on gold. So me personally, I'm just giving it, it's one of many positions, and and it's a more of a trend position and a way to diversify, and so I'm giving it some room to the downside. If it can reverse sooner, great. But again, needs to take out ultimately. What would be extremely bullish is to see that again triple top that goes all the way back to they're just above that 2011 end of the bull market there, beginning of the next that last bear market high, and now they're about equal highs right here. Okay, a quick update on natural gas. Somebody asked about it in the previous post I put out this morning, so I'm going to get to that chart. You can check that out, or I'll just cover it real quick here. It'll only take a second. All right, so they were concerned, as I am, somewhat concerned, but I'm still holding my short This was that primary trend line here. Remember, we had the secondary or minor trend line. That was our short entry right here, as well as that 656 support. Played out nice. And then I highlighted yesterday on a back test of the trend line. Well, we've creeped above the trend line. And so that's somewhat concerning. You might want to hold off on adding or initiating if you didn't short it yesterday unless it falls back below that level. I'll zoom in 1 second. Let's zoom in now. Let me just do, because I just want to show you the primary trend line. So let's go down to, we'll stay on this hourly candlestick chart 1 month. So that's what it looks like. We've taken it back. But my comments were, first of all, nat gas is a whippy little sucker. By that I mean it's moves so fast, so hard. In a single day, this commodity, and when volatility is up like it has been, easily goes up and down 10% or more in a day. Not each and every day, but that's the norm. You're not going to see many other commodities that move 10% more in a day. Gold usually won't do it. A lot of other commodities don't move that much, and so with that you tend to get whipsaws because of the way it moves. Put in that divergent low the other day right here. I just had it drawn out. There was a a positive divergence, and it played out, and it took us again to the back test, and we've recovered the trend line. But remember, I had it color coded on my chart yellow because that was a big level. And it still is a big level to me. We had a lot of reactions. We had a breakout there and a back test, and then boom, the final top, which may prove to be a blow-off top. I talked about that before. Another test with a big rally there, and then when we finally took the level out, the bottom fell out. So this, to me, 7,784 is probably as significant as the trend line. So again, not crazy about the fact the trend line's been taken out, but this is what I call BOD line, benefit of the doubt resistance level. If they can take that out with conviction, that's bullish. Anything more than the brief whipsaw. And again, you got to allow for a little bit of whipsaws with natural gas. It's just how it works. It runs so fast, but so that's the level. And if they take that out, then like I said, that's going to be near-term bullish. Could rally up again to that level. Look for a PPO crossover, and you get these high-level bearish PPO crossovers when you're coming down from real low there. That also could trigger some selling. You could probably add a trend line here as well, right there, something along those lines. I don't see a really clean trend line I'm crazy about. Really can't draw a nice one off the lows. So I'm just going to remove that, and we'll just watch that level there. But like I said, it depends on your trading style, where you shorted or where you got in. Where you think nat gas is going. I still have more aggressive downside targets, especially here. Why don't we do that real quick? Look at the daily chart. 6 months, daily candle. So here's what it looks like. First of all, the day isn't over. If you're trading on this time frame, and this is what I showed you, bigger picture, you have this bearish rising wedge. You have a bearish engulfing candlestick right there. That's a potential topping stick, confirmed with a follow-through red candle the next day. And then my long-term target is all the way down here at 5089. So the ideal scenario would be to see a reversal today and have nat gas close on or back below that trend line, because all that'll be is an intraday whipsaw. When you're trading any time frame, including the daily time frame, the only thing that matters is how that candlestick closes. That one's not finalized. That one's going to keep going, and then today we'll know if we regain that trend line. And the greener it is, the higher it goes up, the more obvious it is that that level's been regained. I'm talking about the trend line. And if we close back down on or below it, then you want to start seeing it move away from there pretty impulsively. And like I say, the redder the better. And then last but not least, most importantly, you now have effectively about a double bottom low right there. So this is the level that needs to go. That would be the next check mark for the bears, or an add-on to a short position if yesterday's low gets taken out. Okay, and on to the markets. So the post I get out to you this morning, key levels to watch on NASDAQ 100, NDX futures. And I'm sorry, QQQ folks, I'll get those charts out when I can, but with all this volatility, a lot happens around the clock here, overnight, after hours, and those trades are not, you can't see those. So Looking at NQ, if you guys are boaters or fishermen, you're probably familiar with polarized glasses. You put on a pair, most glasses are not polarized, most sunglasses. So when you're out on the boat, you look down, you can't see below the water line because of glare, sun hitting the water. You put on polarized glasses, it cuts through that glare on the surface and you can see the fish, the rocks underneath, again depending on water clarity of course, but that's, so I use that analogy with the futures because you're seeing a lot more trades. You're seeing where buyers and sellers have met at 8:30 in the evening, 5 in the morning, 3 o'clock at night. Volumes drop off, but there's still significant reaction levels. So that's what we're looking at here. NQ, Globex futures. Globex are the round the clock, virtually round the clock trading. That's a big range right here. See, we had, as been the case, we keep getting these divergences, bullish divergences, falling wedges, other things like that, and they play out just like gold's been doing, play out, but not for what they used to in a bull market. Used to get a little divergent low like this, boom, hit it and run because that's your next leg up. But what we've been doing here is they've been selling into the rallies. That's signature bear market action. When you get bullish setups, they break out, and just as soon as they start to get going, the sellers step in. Now, something, a little bit, again, I'm now speaking microanalysis. I'm on a 10-minute chart here. These are 10-minute candles. Just the last few days of price action. You can see the dates down here, May 6th, 9th, 10th, 11th. All right, so Monday, Tuesday, today. All right, so this is what's going on. There's a little near-term battleground right now between bulls and bears. This was that big level that broke down the other day, really right about here. So on the daily chart, the bears won that recent battle, one I called D-Day, but then the next battle occurred. Probably as important as that whole D-Day level I was talking about are those levels on the daily chart. Let's not forget we just hit my yesterday, was it the my second targets, which were key support levels on not just QQQ but on SPY, and that's not random mere coincidence. Those are targets that were laid out months ago. Those are very important support levels. So you don't see it here on the 10-minute chart because you don't see the trades back that far. You have to go out to the weekly chart to see, and so that's it. So let's not overcomplicate things here. To me, it's pretty simple. If those lows are taken out and it's anything more than a whipsaw, and that's why I always say be flexible. You could break down. You probably see a big spike down because stops are going to be hit on longs and shorts will pile in. But if they reverse it, then you have to recognize, oh, okay, that might have been that looks like a bear trap, false breakdown. And then you might want to, if you shorted it, you might want to cover or, act appropriately. Again, your positioning is going to be different from mine or the next guy or gal. So, but that's it in a nutshell. Let's say you short it because you're an active trader and you see them ramp it back above there. And if it looks like it's holding, you may want to cover, scale out, and even maybe go back long. Likewise, I told you today, this is the big level here, about 12,560. You can see it was support. That support broke. That's fair. There's your sell signal, break of support. Tried to back test it. Support once broken becomes resistance, rejection. Rallied up, tried it again, rejection. Tried it again, rejection. Tried it again, rejection. All right, so that's a pretty significant level. And that's why if they can pop that, then it's likely going to spark a rally. And each of these levels are where you could get a reaction. And that would be a near-term target. And you need to understand from where we're at right now, or let's just go from the breakout. Well, I can't grab it. I can't measure exactly on it. It moves that line. I'm going to grab a little below and stop a little shy. That's 8%. That is just a 10-minute chart. That's a potential near-term target because I think this is a pretty powerful little, back and forth area of consolidation. Again, I use that coiled spring analogy. The more you consolidate and bounce in an area, it's like building energy like a coiled spring, and then when you finally break, you can get a pretty impulsive move. Now, keep in mind, okay, so you say, okay, 8%, ride that out. Well, if it happens, and it happens soon, that has the potential to change things on the longer term, more significant daily charts. It's going to firm up, if it happens today, let's say, it's going to firm up the divergence, the positive divergence that's still hanging on by the skin of its teeth on the 60-minute charts and daily charts. It's also going to show a successful defense of those key support levels, my second targets on the weekly charts. And as I say, quite often, but not always, the initial tag of my targets, you get a reaction, sometimes a tradable reaction, and sometimes, even though I have additional targets I'm still maintaining for now, there's sometimes in my trades you hit my second target and I might have three or four, and that's it, that's the end of the run. It's support. So I'll be able to tell you with more confidence, and as I've been saying, if we take out the recent lows with conviction, we've taken out those second targets on SPY QQQ weekly charts, and that will increase the odds we're going to go on down and hit my third and probably fourth targets. Otherwise, we pop this, well, it doesn't take T3 and T4 off the table, but it's going to take them off the table for the near term. It's going to sharply reduce the odds of it even happening at all. The odds are just like, we just had the Kentucky Derby. I'm not a big betting man, but I went 10 years ago, and I noticed the winning horse. Gosh, I forget the name. Probably heard it. The odds were finalized at 80-1. And what was cool when I was there, I remember, it's the first time I bet on horses. The odds are constantly changing up until the betting locks right before the race, and that's because the house is taking it's kind of trying to balance out the bets. If more people are betting on a horse, the odds of that horse winning are going to go up. And so anyways, the stock market, I view it that same way. We pop here, we're going to probably have a run, especially if it's not just a whipsaw. And the more you go up, it increases the odds that maybe T2 is held. And then we have daily divergences that could turn out to be the catalyst for a rally that can last weeks, if not months. I still think it'll be a bear market rally, but I can tell you if it is, let me just jump over to those charts for you. If it is a bear market rally, and we get it, again, it hasn't happened yet, take that level. There's my T2 on QQQ. Look at it, holding like a champ. This is a weekly chart, 299 to about 298. On the daily chart, it's 298, right? 1, 2, 3 days there. So say what you want about technical analysis, but it's just amazing to me how well it works. 3 days, that's a reaction. I define a reaction as a bounce and or a consolidation. So far, based on the scope, you can call it a bounce, as a small bounce, but really consolidation based on relative to the move leading up to it. And so this is a battleground. So if bulls can do this, then they have this trend line and they have this bullish falling wedge, and they will confirm that positive divergence that's still just clinging on, and then that could set the stage. The measured target is the widest part of the wedge, so you could have a rally up here. It could be, and again, doesn't mean it can't go higher. That also comes right in with that 200-day moving average, right, that checked these levels. But let's talk about that now. Even if you're a trend trader, do you want to ride out a 22% bear market rally? Probably not. So you have to make the decision and adjust and adapt. It doesn't have to be an all or none. I don't make, for my trend positioning, I don't usually make all or none. I'm talking the long-term accounts, IRAs and stuff. I'll scale out instead of just flip from a full short position on the indexes to a full long. I'll set staggered stops and scale out. And I'll usually scale out strategically. What does that mean? Not just 3% or whatever your number is, but I like to use the technicals because, again, I talk about those moving odds, how they change minute by minute, day by day in the market. So if they pop this level, then I'll maybe cover some. If they pop this, maybe cover some more. If they pop this, cover some more. And at that point, I might be even long for the ride up to that level. All depends on what I see. There's a ton of things. Let me show you one other thing I'm watching before I get away from the indexes. Let me show you ES. Same thing. ES is the S&P 500 E-mini futures. Remember, I had that line just like the one on QQQ or NQ. I had it color-coded yellow because it was a very significant support level, and that support has been broken. And let me just say this one more time. I'm talking about the risk of this rally, but right now the bears are in control. They took out that support level. They've defended several rejections by the bulls. Bulls tried to get up there and get above it. And so far the bears have defended that level right there. So that's the level to watch on the S&P 500 futures. You have pretty much a double bottom low, and again, it's At the risk of oversimplifying it, this is the most likely scenario. If they pop it, we'll probably rally. If they pop it to the downside, we take the next leg down, and that's big because we've also taken out that long-term support. Last but not least, let me wrap it up here. There's a million and one things I watch, as you know, put to call ratios, bonds, gold, all the major leading stocks, the big fangs. But the one to really watch right now, if you're going to watch one stock, the more you can watch, the better. It's Apple. Apple is the final holdout. It is the 800-pound gorilla. It is the largest company in the world, largest publicly traded company. It is, more importantly than that, you might sound fancy, it is the largest component of the NASDAQ 100 and S&P 500. And so for that, simple mathematics, if it breaks, it's going to put a lot of pressure on the markets. But more so, it's the psychological importance. This is the leader. This is the king of the stock market for decades now. And Apple fans are diehard, whether they're users of their products, you're a Mac, Apple, iPhone guy or gal, or you've held the stock in your portfolio and you've learned over the years that don't let go, it'll come back. But when it breaks, it's going to have both a mathematical importance or significance of the market due to the weightings, as well as a psychological component. Don't underestimate that. That is everything. That's really what technical analysis is really based on. Those levels, the reason trend lines work and price horizontal support levels, there's a psychological component, because when people buy a stock that has support at 100, every time it pulls back, they buy, and they learn that, like Pavlov's dogs, they're rewarded for buying it. Finally, that level breaks. There's a lot of, and the more people that bought, that's why the more reactions on a support level, the more eyes watching, then the more people are disappointed and they sell it. So that's one way it works. And look, we've cracked my uptrend line. I've been highlighting this trend line for a long, long time now. Right here, comes back from 2020, right there. We're below it, but we're not waterfall selling. And on a weekly basis, they could regain it. My next support level, and it's a yellow line. I've had a color yellow for a while, meaning that's a pretty significant level, 150. And why is it significant? Well, one reason of many, it's the previous reaction low, and we're also below. Look, we've taken out the 200 days. Sometimes you take them out briefly and recover, but they act as great support. Apple buyers, again, Pavlov's dogs. The bell rings, meaning you pull back to the 200s, you buy it, you've been rewarded, and that's happened for a long time. But then the other big psychologist I like to use is B.F. Skinner, and he was the one that his big thing was negative and positive reinforcement. He had that little box, and the rat hit a button, and you get a pellet, a little treat, right? And you keep hitting the button, and on one day, B.F. Skinner hook it up, instead of getting a treat, the rat hits the button, he gets shocked. And so how long it take? Longer he's hitting the button and getting a treat, the more he's ingrained in that behavior. But ultimately, when he starts getting shocked, and let me bring in that analogy. Here's QQQ. Let's talk about that. Okay, and this is reward, dip buyers. I'm talking about the dip buyers. Even though, as I said, it's been a thing lately. And now the Wall Street Journal came out with a pretty in-depth article about the people buying the dip yesterday, and so they bought the dip here. Got it. There were a little rally. They were happy, but ooh, ouch. Okay, I'll buy the dip again. If the old joke, I used to be a broker, and I was ethical, but we'd make little jokes, side jokes that, hey, we wouldn't say this to clients, but kind of like that boiler room talk. If you liked it at 100, you got to love it at 50, right? That's the old joke. So when they bought the dip, so they bought it again. They got their rally. Yeah, I was right. See, all I had to do was buy and hold. Oh, happened again. Okay, we rallied. Oh, another low. See, this is, and then finally, got up here. This was a big level, because that's where that previous reaction high was. You had a big rally, and then once this rally got faded, that right there has crushed the dip buyers. And you can, if you're a journal subscriber, read that article on the dip buyers, and then it's just comical the type that they, these, and they address what I already know. The vast majority of dip buyers in recent years, and on this dip on the way down, they even had some pretty solid statistics, are the newbies. Even Robinhood CEO came out when they had earnings. They said that, hey, the most of our clients, they're new to investing. They were armchair investors when COVID hit. They got their stimulus checks and they started buying stocks. They don't know what they're doing. They thought they knew what they were doing. One of my favorite quotes is, never confuse genius on your part with a bull market. In a bull market, you get bailed out. You can make mistakes. You can have the worst market timing skills in the world. In other words, you can buy this high and you can buy that high. You can even buy that high instead of buying the lows. You keep buying the highs, the absolute worst time, and you immediately go down. But guess what? The bull market's going to bail you out. And it does that long enough, and that's what ingrains that psychology and that mindset of dip buyers. But when you can finally break them, when they finally hit the button enough times to get shocked instead of getting a reward, they finally start to capitulate. And there are people with iron fists that believe, hold long enough, doesn't matter how low they go, to come back. Well, the problem with them is a lot of those folks bought on margin. And as I explained before, which again was also, well, no, we haven't seen that. I haven't seen the headlines come out, article on that yet, but I know it to be true. I've done this long enough. If we keep going lower, you're going to read and hear about it. Forced margin call selling, where they might love their AMC and their GameStop and their Peloton and even their Apple. Apple, great company, but again, the farther we go down from this point, the more forced margin call selling you're going to get. And then it is, as I explained before, it is a vicious cycle, because selling begets more selling, prices go lower, forces additional margin calls, and then at some point, if it continues much longer, you're going to have the brokerage houses are going to start increasing margin requirements, which will then further exacerbate that. So we're not there yet. I haven't seen what I consider waterfall selling. It's been persistent selling. Can't argue that. Nothing but red sticks on the weekly chart now for 1, 2, 3, 4, 5, 6 weeks in a row. But not what I'd call waterfall selling yet. Waterfall selling, this is a waterfall sell week right here. See that big red candle? You start getting those, and so that's where I think we're at. I think we're sitting right on the edge of a potential cliff, and if the bulls can hold the line, they can rally it up. And I just gave you a potential target, maybe up to that 200-day moving average, about 351 right there on QQQ. But if they fail to hold the line and the bears win this one, and the Bears, like I said, need to. I used that blitzkrieg analogy the other day, and I mean that. They need to push it hard here, take it down, take Apple, because the more time, the more consolidation we do, the more things stabilize, volatility comes down. Bulls become a little more emboldened, thinking the bottom might be in. They start buying. And more importantly, you're not getting that forced margin call selling. You're giving everybody time to catch up. You're giving people time to get money into their brokers to meet margin calls, if they have it, that is. So that's where I think we're at, guys. I don't think we're going to sit here long, is what I'm trying to say. So, if we do break to the downside, just do not underestimate. As oversold as you think the market is now, don't underestimate how far and how fast it can drop if that level's taken. Likewise, don't underestimate how far we can bounce and how hard if they hold the line and money starts flowing in and those divergences are confirmed. So I don't consider what I'm telling you here wishy-washy analysis, because I've given you levels that will most likely determine which way we go. And if those levels prove to be wrong, I'll continue to do updates. So that's it. In summary, I'm sitting tight now, my swing shorts, and favoring more downside, but I will adjust accordingly, as I said earlier, based on the levels that I've mentioned and developments and other things, and including but not limited to Apple. I'm really watching Apple to see if we can break there. That's one to watch, and you can see it's starting to creep up on those recent. Actually, just took out the recent lows, so that could be it. That's what I wanted to see right there. This is a 1-minute chart, and the farther we get away from these recent lows right here, about I'll call it 151, 150. The better the chance we're going to have of breaking the support in the markets and finally taking Apple down. And Apple's got a long way to fall. I'm going to give you one more target here, and then I'll wrap the video up for you Apple shareholders. That would be my first target, about 105, 105.50. No, take that back. I'd give you a first target about right here, about 122 or so, and that would be a drop of about 19%. Next target about 105.50, drop about 30%, and then before this bear market is over, I think we'll come and touch this long-term uptrend line and this 82.64, which would be, as you guys know, where I'm targeting the markets, what I call the pre-COVID highs, where we were in February 2020. You've got that major reaction high there, and you also have a long-term trend line that should come in depending on when we get there, like something like this. Well, I didn't draw that to scale. Let's do it one more time. Grab that down. You see where I'm going. Maybe get a reaction there. Early on, probably not much of a reaction. Maybe a bigger one on that second tag down here, and then ultimately head down there. They're both in close proximity. Maybe you overshoot it during the week, only to close the week back on $82, $83 right there. And at that point, if I see what I like on the indicators and on the equity indexes and the other FANG stocks and bonds and everything else, I might be looking to enter a trend position or a long-term swing trade in Apple to go long. Right now, I'd be more apt to stay short or go short in Apple, especially if these levels are taken out, than I would be to go long here. But that can change. It could change in a dime, and if I pivot, I'll let you know. All right, guys, I'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.